the theory of efficient market pricing is based on people taking independent decisions. And as you can imagine, a Reddit thread that is trying to create a mother of all stock squeezes is literally the opposite of people taking independent judgments on a stock price. They're deliberately trying to create a community-led bubble.
Have you ever wondered how fund managers deliver a successful long-short strategy? David Seaman of Alpha Cygni Investment Management recently joined me for a conversation with Richard Stuckey, fund manager of the Ennismore Global Smaller Companies Fund, about how to manage such a strategy in global smaller companies. In this fascinating chat, Richard talks about the different approaches to shorting equities and how it involves a different approach to risk management at a stock level and at a portfolio level. He outlines a couple of examples of stocks he and his team have successfully shorted that turned out to be deceptions. We then discuss a couple of long positions he has recently added to his portfolio: the UK-listed animal genetics company Genus and the Scandinavian-listed games publisher Paradox Interactive. Richard then goes on to discuss the geographic spread of his fund and how to think about market inefficiency driven by the rise of the mega-cap tech stocks, passive investment, and meme-driven markets. And, importantly, how to adapt investment strategy in a market that can remain inefficient for a long time. This is a masterclass in the often counterintuitive art of managing an absolute return strategy in a volatile and illiquid asset class. While not for everyone, it can offer downside protection in choppy markets, while still providing long-term exposure to quality compounding equities. I must remind you that this is all just for information purposes only and is not investment advice. The views expressed in the podcast are personal to the contributors and they do not represent the views of Progressive Equity. Please enjoy our conversation with Richard Stuckey.
Brought to you by Progressive Equity.
So, Rich, thanks for joining us today. Could you just set the scene for us and give us a bit about your background and your investment journey and your path to joining Ennismore?
I got into investing, I guess, partly as a function of moving away from something in my job. I was a management consultant at Bain, and it's a great place to work, lots of great people, and I'm still friends with many of those people. But on the work side, I found it very focused on presentation, I guess, and that was both internally and externally. You know, it was difficult to tell whether you'd done a good job for a client, and it was more important in many ways whether they perceived that you'd done a good job rather than that the analysis was valuable and that had a big impact on the company. And then internally, you know, whether you were perceived to be doing well was a lot around whether people thought you were doing well and not necessarily the contributions you've made. I had this desire for something that was more concrete, I guess, more observable. And investing felt like that, you know, where you had a track record and you had numbers to say, have you done a good job or not? I went to the credit side of Bain Capital, which back then was called Cygni, it's now called Bain Capital Credit. And that was a great learning experience. We did lots of work on lots of different types of companies, but I found that credit wasn't for me. Generally, obviously you can take over a company from owning the debt, but generally your upside is capped. And because you can lose a lot, but you can't necessarily gain all that much in a lot of the positions, you generally are having a very diversified portfolio. So you end up looking at all sorts of companies. You have to look at what's available in the market rather than being able to pick and choose your spots. And I was starting to find businesses where I thought, you know, this is a really exciting opportunity, a really exciting value creating business. And I wanted to frankly own the equity upside. And I wanted to focus on some of those niches rather than kind of looking at the next company that came along in the processes. And the other side of that was there was a stuff around process in credit where, you know, it was wining and dining the RBS guy at the time who was running their troubled loan book rather than the value add of the industry and company analysis that was the big driver. I decided I wanted to move into equities rather than credit. And I guess my first initial exploration was working on a fund launch with a couple of friends. I think, frankly, looking back, I was probably a bit green and that was a little bit optimistic. But my friend who was working on it did launch the fund, and that's still going today and very successful, called Alpha Capital. I then took a job with Adelphi Capital, which was a European equity long-short fund, and that was a great experience. I was there for 3 years. After that, I took my current job. So I came to Ennismore in 2017, which was following a colleague of mine from Bain Cap called Alex Fortune.
So you had a bit of a parallel route into equities via credit to Jeff, who talked to us back in the summer.
That's exactly right. Yeah, he always says, that experience of seeing what can go wrong with companies is formative. And I think that's exactly right. It's partly what can go wrong. And the other thing, probably the biggest thing for me, was learning just how rubbery accounting concepts can be. So I think there was a business I was following where the leverage or the debt to EBITDA that is disclosed on the credit documents is dependent on company definition of EBITDA. And, as we know, EBITDA is not a GAAP concept. Some of these numbers that the companies managed to come up with were frankly unbelievable at the time. 2007 was a period of very loose credit markets. And there was a company that was, by any stretch of the imagination, unprofitable, but because of all the add backs that they'd managed to negotiate into their loan docs, it was profitable, apparently, and meeting its covenants. And so the lenders weren't able to get their hands on the business, even though this business was burning loads of cash and clearly should have failed its covenant.
And in your journey to equity investment then, who were the most influential people in you developing and honing your own investment philosophy and process?
A lot of my learning came from reading. So, I read a lot whilst I was at Bain Cap. I read all the Buffett essays, Phil Fisher and so on. There was a phenomenal series of journals. It used to be called the Outstanding Investor Digest. I don't know if you came across that. They used to do these really in-depth interviews with investors, and I got a lot of value from those. And then a series of other books that I read since. One of the more recent ones is The Quality Investor, which is the kind of AKO book that talks in terms of business models. And that really worked for me, that way of thinking. When I kind of came across that had been how I'd been thinking before. I was saying to you how, as a credit investor, you have to look at all these businesses, and that didn't really do it for me. And I wanted to follow niches. I discovered online classifieds as an example in 2010 when I was at Bain Capital. It was harder to make those investments because they don't need much debt. And because it was a new business model, lenders weren't willing to extend that much debt to them. So that was more of an equity area. And that was one of the genesis of me wanting to move into equities, was seeing the potential for these businesses. And so then I wanted to look at all the businesses I could that were like that around the world, and I went digging for them. And so thinking in that kind of business model framework, that had been how I'd been approaching it, and reading that book kind of crystallized it for me. In terms of people's influences, one of the big ones is I'm probably somebody that can overcomplicate things and look for how to use the data that's available. I want to find, all the information I can on the company. And perhaps the biggest influence in trying to push me away from that approach was Leo, who hired me to Ennismore. And he was phenomenal at simplifying things. You look at a model that he'd made, and if we were to model the same company, I might have, 500 lines on a spreadsheet, and he would probably have 25. The point of a model is to kind of, allow you to look at scenarios, learn about, what influences the economics of a company, and also to kind of think through the potential and the possibilities. And, his models would do that without all the extraneous detail. So, the simplicity that he brought to the job was definitely an influence.
It's how much data and analysis do you need to actually make a shot on target?
One of the hidden benefits of simplicity is the clarity it can help bring when you're constructing your investment thesis, and then the ease with which you can recognize if that thesis is failing. That's
a great point, David. And that's another lesson from Leo, actually, is adopting a kind of scientific approach to thesis development and thesis testing. Is what is my thesis? Why am I making this investment? And then rather than endlessly searching for data to support your thesis, how might I disprove it? How might I test it? Try and prove that it's wrong. And what data would I need to do that? And so then it allows you to do two things. Firstly, be doing useful work, potentially discard an idea that isn't good and doesn't hold up to your checks. But secondly, it makes the search for information and data intentional rather than pulling together data that's available and seeing what conclusions you can draw from it. Absolutely. And that's a much more valuable approach, is to say, what's important to this case? What data and information should I be looking for? Rather than what data is the company making available to me?
Yeah, it's all about falsification, isn't it? Understanding. If you can't falsify it, then it might be true.
Absolutely. And yeah, so he's a kind of hidden scientist and regretted the art side of his degree. So he's now gone to study astrophysics, having left the investment world temporarily.
Man after your own heart, David.
I went the other way around. Yeah.
He's an astrophysicist turned fund manager. I think most people who listen to this podcast are at least interested in investing and probably own investments, and they're long of assets. Can we just try and dig a little bit into what makes a good short thesis and how you manage the risk profile of a short book in a long-short strategy, which I think is slightly counterintuitive to the way most people think about the investment landscape?
the nature of the risk reward profile of a short position are different to a long position, and in a problematic way. So when you own a company or an investment in a company, then if it goes the wrong way, if price is falling, then your position is getting smaller. Say you have a 5% position. If everything else in your portfolio doesn't move and it drops to 50 from 100, your position becomes 2.5% and it becomes, less impactful to your result. If that happens with a short position, the position is getting bigger. And so that it's the first problem that you have to deal with. And then the second problem that you have to deal with on an individual name basis is, obviously if you don't add to that long position, then the most you can lose is your stake. So that 5% position we talked about, the most you're going to lose is 5% if you don't add, even if that company goes bankrupt and the stock delist. You can lose much more than 100% of your position with a long. And so there would have been people who were still short Kavana, for instance, at $2 or $3 when it was on the cusp of bankruptcy or thought to be on the cusp of bankruptcy, staved off that bankruptcy. And now the stock's probably up over 100 times, if not more, in the 2 or so years since. And so they probably haven't lost 100 times. But that possibility is there. The problem with having a long short book is that you have another layer to the correlation. With a long only book, you have 100% of your equity that you're invested, and your different positions may correlate in different ways. When you add a short portfolio to that, you're likely to have over 100% of gross exposure of that equity. And so potentially you could have your long book pulling in one direction and the short book pulling in exactly the opposite direction, which is great if that's the long's going up and the short's going down, but it could be pretty painful if it's the long's going down and the short's going up. And so you're adding complexity and more range of possibilities to the problems in, say, factor movements or momentum being an influence on your portfolio. In terms of how I and we approach shorting, there are 3 categories of things we're really looking for. One is deception. And by that, I mean, for instance, a company that we think is a fraud. And there's a surprising number of those out there. People might like to think that, company management teams are all working in their favor and doing their best for the businesses, but there are crooks out there running some companies in the market and some who are professionals basically using the stock market as a tool to enrich themselves. It also ranges to accounting that is, I mentioned before, accounting can be a rubbery concept. This definition of EBITDA that was very, very generous to the company. And, accounting, whilst it can feel like a very rigid set of rules, some of those rules are less rigid than others. And so some of them can be manipulable by management teams. And so the numbers don't necessarily represent reality. Another type of short that we do is just fundamentally challenge businesses. And so this could be businesses that are suffering from, some major technology disruption. It could be some big disruption or big shift in distribution. Like we saw in, say, insurance, 15 years ago in the UK, you had this huge emergence of price comparison, and that was very disruptive to the incumbents. Or it could be a new method of production that's much cheaper or capital efficient that's hard for an incumbent to shift to. And then the third category would be companies that are cyclically over-earning. And typically this is likely to be something where investors are extrapolating the recent past, or sometimes the kind of medium recent past, into the ever future. And it's a business that's fundamentally cyclical, where that extrapolation is likely to be wrong. And sometimes then you can see pretty major mispricings of businesses of that type as well. But that's trying to call a recession. So businesses that can fit into this type of category could be, say, cruise ships, where you have a pretty long history of what the valuation per berth might look like. And so you kind of have an idea of where you are in the valuation cycle. Is a berth valued at, a couple of $100,000 or $500,000? And then you have major cyclical variation in margins. And the key thing with these businesses is that it takes 3 or 4 years from ordering a ship for it to become part of your fleet. Because they're so big and complicated, they take a long time to build. And companies tend to order more ships when they're making loads of money. They'll buy back some stock and maybe pay a dividend, but they look for stuff to do with their business, and everything looks great. They'll order new ships, but it takes 4 years for them to come. And so if all the companies do that at the same time, you may end up with, rather than a normal 4% addition to the fleet, you might see 8 or 9 in some years. And when that happens, it can be hard to accommodate all that new capacity, and you're likely to get a pricing issue to fill it.
Is it possible just to give us 1 or 2 examples of one or more of those types of short that you've executed historically and the type of companies we're talking about?
The most fun ones are probably the deception ones. So I mean, maybe those are the most enjoyable to talk about. There was an Italian company that we were short going back to, I'd say 2018 or 2019, which is called PIWORLD. This was a €1 billion company at its peak. and it was a bioplastics producer. So it used a technology called PHA. It's been around for decades. It was developed by Procter & Gamble, I think in the 80s even, but they could never monetize it. They acquired some technology out of Procter & Gamble. And the problem with this technology was it could make a plastic, but the plastic wasn't as easy to use as oil-derived plastics, and it was much more expensive to produce. There wasn't really a commercial proposition. Obviously, in this context, it would be wonderful for the world if we could have a compostable, non-oil-based plastic. So you feel a bit bad.
It's got a natural supporter base, hasn't it?
Yeah, it's selling,
before you start. Yeah,
environmentally fantastic proposition, but it's not realistic. And if the world was to make all these plastics with something that costs 5 times as much, that probably wouldn't be as beneficial as its proponents might hope. So we studied the technology, we studied the cost of producing, and we just didn't believe the numbers that the company was reporting. The problem with this kind of situation is it's pretty easy for these companies to gain some credibility because their natural customers have an interest in promoting their ESG credentials. And they don't need to necessarily, contract with a company to buy one to gain credibility from them. So, they'll arrange some kind of very half-hearted partnership, but then that features pretty heavily on the website. So if you looked on Buy One, they had Unilever slapped all over the website because they were doing some very kind of early stage test of their product in their cosmetics. And that became a major feature of, Buy One's investor communications, where they were saying, well, okay, we can't sell the kind of base plastic at a good margin, but we can sell into the cosmetics industry at 10 times the price. And so then it worked. So the key thing with the research on this company was that they were faking the numbers. So not only did the economics not fundamentally work, but they were agreeing deals with customers, or customers in inverted commas, which were essentially fake. And so how do we go about testing it? They'd have kind of 5 or 6 contracts that they'd announced, one of which was with a French company. And it was supposedly a 60 million contract where this French company was going to build a plant and license the technology from Buy One. It was going to be a big deal. But these contracts would get announced and revenue would get recognized, and then there'd be a big receivable on the balance sheet, and they weren't disappearing. So the revenue was being recognized and no cash was being received. And when you looked at this French company that was the customer, they didn't have a corresponding payable to Buy One. So the situation was quite comedy. You had this big receivable that was there for 2 years, but no payable on the other side with the customer. And they had no cash to pay the bill with either. So it was unlikely that Buy One was going to receive cash from them. And that was replicated across various of these customers. We also spoke to a Brazilian guy that represents their supposed customer in Brazil. And he, in not so many words, identified it as a sham contract as well. So we were pretty confident that the business was built on sand. And we were lucky in that case because a short seller report came out a few months after we developed our short position, and it fairly quickly collapsed. It ended with quite a dramatic film scene of 30 Italian cop cars arriving at the headquarters of this company and marching the CEO out of the office. And then he was subsequently tried and convicted, and eventually the asset was sold at 10% of the debt. So the stock went to zero.
So how long do you think they could have perpetrated it if the short seller report hadn't gone out? Because some of these things can hide in plain sight for a long time, can't they?
No, it's very true. And, it's scary to think what that stock might have done in 2020, 2021, for instance.
Yes.
When the ESG theme was at its absolute peak and speculation was at its peak. And so if that company got taken down in 2019, but if it had survived to 2020, it could have been a real tough situation. The share price could have gone ballistic, I think. So timing is important with these things. And I suppose pragmatism is, to your question on how do you manage the risk, there's an element of being pragmatic. It's tempting when you're very certain of your analysis to want to hold on to positions. But with the short side and the asymmetric risk reward structure that we talked about, it's important to be pragmatic and walk away when you're in the kind of facing a steam train coming your direction in the context of, those ESG flows, for instance, that we saw in 2020. But in terms of how long could they have carried on for? I mean, I suppose that relates to investors' willingness to fund them. That was part of the problem in 2020 and 2021, that business models were being funded that had no prospect of economic success.
When you've got free money and a world pumped with liquidity, these things can go on for much longer than you might think.
Yeah, that's right. And, it's only in response to the short seller allegations that the police got involved in this case. The regulators, both industry and accounting, don't do a great job of clipping the wings of these kind of companies that are doing wrong and defrauding investors. And then, investors don't do enough diligence during these very optimistic phases. And so business models don't struggle to get funded. It's an interesting question to think about. And in this case, the accounting was very obvious. This company had recognized an enormous amount of revenue but received almost no cash. And so it was pretty obvious. So investors hadn't done a great job either at this point. Looking at a US example and a more recent one, there was a company that was one of the latter stages of the SPAC bubble. It came to market in 2023. This was called Mondi Holdings, and it's still listed, but it seems to be on its last legs. It's just comes on its reporting for Q3 numbers. It's filed late, or has yet to file its Q3 10Q, which is now 10 days late, amended its credit agreement 25 times or something in the last 3 years. I think it's on its last legs. It has too much debt and it's not going to escape from it. And this was a company where it was being pitched as the AI disruptor of travel. And it had launched an app where Abby, their AI assistant, was going to be kind of it was supposedly the first to market and the most important AI agent to organize your travel. But when you downloaded the app, it just didn't work. I reckon as a non-developer, I could come up with something. If I hired a couple of developers off Upwork, I reckon I could have come up with something similar in about 2 weeks. It was probably the worst consumer product I've ever used. You would ask it for an itinerary and it would, for Paris, and it would say Eiffel Tower pretty much. This was clearly a product that didn't work. What the business actually was, it's called a consolidator. So airlines back in the day, if you go back 30 years, and they were looking to access the ethnic Chinese market in New York, for instance, they'd want to sell into the physical travel agent in New York, in Chinatown. And they would offer discounted fares on, New York, Shanghai, for instance, to fill up some of the capacity because they struggled to access that market, some of which didn't speak English. And it was a genuine business. It wasn't a great business, but it was a genuine business. If you're trying to access that market today, you do it by social media. So, this business, if you were building it from scratch, wouldn't exist. And it had been kind of declining. When they, obviously thought, IPO, a structurally declining business, they needed to come up with something that was a bit more exciting. And the AI agent was the solution they came up with. And so this extraordinarily indebted, largely cash-burning business managed to achieve an almost $1 billion valuation. And now it's down to less than 100 million. As you say, it seems to be on its last legs. But it was not easy to work out what the business did, to be honest. It was one of these businesses where if you read the filings, you were left a little bit confused as to what the actual business was. We came across it and it had lots of flags and things seemed strange, but it took us probably a couple of weeks to understand what the actual business was. And then we had a deceptive business with a structural decline and pretty dodgy accounting. So it was most of the things we're looking for.
So how does shorting then allow you to adapt the overall portfolio structure? Does it affect how you look for long positions, what you look for in a long position?
From a portfolio perspective, what we need to be careful about is, having talked about these deceptive companies, you can end up with pretty spicy, high beta exposure on your short side. The other thing we have is more of these more questionable companies with dubious management teams tend to be in the States. And that's, I think, the corollary of the States having the best capital markets. They have the deepest capital markets, the most willing to fund disruptive and growing business models. But the other side of that is that you sometimes fund these fraudsters as well. We tend to have a bias to having more US shorts. And so balancing that with US longs is sometimes a problem. And then secondly, as I say, you can have these very high beta short book, whereas my natural long tends to be more stable and much lower beta. So your short book and your long book can sometimes behave out of whack with one another. So that's the issue that we need to manage.
And how do you manage that?
The biggest way we do it is just by having a relatively net long exposure. We offset the higher beta nature of the shorts with a bigger gross long. And so typically our long book is fully invested, call it 100% or 105% invested. And our short book would be anything between 35 and 50% invested. And that then gives us what looks like a net exposure of, 65 or 70% of the equity. But actually the experience of that is much, much less. So what we'd call the beta adjusted net exposure, the real economic exposure is much lower than the headline number. As in, when the market goes down, our portfolio won't go down anything like as much as that 65 or 70% would suggest.
Let's come on and talk about some long ideas. And I think David had identified Genus as something we could perhaps discuss.
Well, the reason for thinking about Genus in particular, Rich, given the way you described process, when I first heard you mention it, I wasn't sure. Well, in fact, I presumed it was as a short. It's not.
Why that?
Well, the accounting is complicated. It's a business which hasn't generated very obvious returns on capital for quite some time. And, we're going to talk about some of the detail as to why that is and why you think it may change. But That was my first assumption. And of course, given that the share price had just declined a long way. So I assumed that was starting from a high valuation point would have been something that you may have considered as a short. Would you mind walking us through what it is that you see in Genus that makes it a high quality and suitable long for the Ennismore portfolio?
If you can make a portfolio of investments that have a great risk reward profile, as in a successful outcome, you'll make a lot of money. And in a non-successful outcome, you won't lose all that much, then you'll do pretty well. You'll get some of them wrong. You'll probably get half of them wrong. But if they have an attractive risk reward profile and the ones you get right, you make a lot of money on, and the ones you get wrong, you don't lose too much, then you'll do well. I think Genus fits into that profile. You're absolutely right, David. The numbers are noisy. The business is somewhat noisy to some extent. And so let me lay the framework. So Genus is providing genetics to farmers. So it helps pig farmers and cattle farmers, dairy and cattle farmers, to be more productive, essentially. And so they provide pig semen, for instance, to help pig farmers produce more piglets per sow and convert their feed into meat more efficiently. And so that business is actually a very good business. The company splits the economics by the PIC, which is the pig business, and the ABS, which is the bovine business. And the PIC business makes, call it 30% returns on capital. It's the world leader in its space. It's 2.5 times the size of the number two. The cash flows are decent. The bovine business is much weaker, frankly. It's not the biggest in the world in its space. The margins are much lower and the returns on capital are pretty lousy. So that's one place where you have noise. The second place where you have noise is they've been developing a product. So there's a disease called PRRS, which is porcine reproductive and respiratory syndrome, or maybe the R's are the other way around. And that creates a lot of economic and emotional damage in the industry, frankly. Some pig farms will have an awful large number of their pigs will die as a result of this disease. And it causes, billions of dollars of damage to the industry. And Genus has developed a gene editing product where they can basically take that part of the DNA out of the pig that is prone to the virus, that creates the virus, and so have a pig that is resistant to this virus. And that would be massively value creating for the industry. And that has enormous optionality for the business, but it's currently depressing the economics. So they're investing, a couple of tens of millions of dollars in that development process without any revenue. We don't know what the revenue will look like in future, but it's certainly a big option. It could potentially do as much as double the revenue per pig that the Genus gets. And then the other big source of optionality is this business has 50% market share of volumes of pig genetics that are sold into the US market, for instance. And it sells into almost 100% of the major US pig farms. But it has much, much smaller share in China. So China accounts for about half the world's pig demand, but only 15% of Genus's PIC sales. And so that's another enormous piece of optionality for them. So you've got these huge opportunities. You've got one underperforming division. And we think in a negative case, the stock's not down too much. If these options don't work out, the stock wouldn't drop too far.
So the underlying setup then asymmetric. Yes, I can see that. And the core PIC franchise is a rare gem. But what you own as a shareholder is obviously the whole. How important is management effectiveness? I mean, how much of the business's overall underperformance in recent years would you ascribe to management decisions or management effectiveness?
I think in any business, management's important. I think there are businesses that can survive bad management, and there's some businesses that won't. In this case, I'm not sure it was kind of negative management, as in, the PIC business has continued to perform very well. It was more a capital allocation issue and perhaps a kind of cost focus issue. And so when we look at this bovine business, the previous management team invested a lot of money into that business, which, if you go back a few years, maybe that was not a great thing to have done. The returns on the business still aren't great. And I think they've also been too hands-off in terms of pushing for cost efficiency and pushing that business to bring the economics up to scratch. I had 4 times as many employees as the PIC business, but a similar level of revenue. The sales methodologies, we don't think they've been pursuing are particularly efficient. We think they can cut. And they've already started to do this under the new management team. We think that business can generally be run a lot more efficiently. And if it's not, then, we would hope that new management might look for a different owner. Some of these optionality possibilities that I've talked about, they've been known for a while, right? I'm not the first person to kind of mention some of these possibilities in relation to Genus. And if you go back to the early COVID period, late 2018-19 and shortly after COVID, PIC, the pig side of this business, was doing fantastic business in China. Now, there's a cyclicality to agricultural economics. At the time, pigs were selling for very high prices, partly because there was a shortage of pigs around African swine flu, and corn prices were not particularly high. Feed, corn and soy, the feed that most of the pigs are fed on, were not particularly high. So the economics farmers were fantastic. They were making great margin, and they were buying lots of Genus's products. And so, I think investors were guilty of bringing forward that, Chinese optionality more than was justified. So their profits were higher and the market was extrapolating that Chinese growth. And then the cycle turned for the farmers. Pork prices fell, corn and soy and wheat prices rose, particularly with the Ukraine invasion. And the pig economics got much worse. And so Chinese spend with Genus dropped. And, people then kind of almost went the other way. The optionality of China was almost kind of written out of the share price, would be my view. For me now, at this point, the share price is not discounting success on these opportunities that the company has. And as a result, that's why we see this attractive risk-reward balance.
Drawing on your experience of the short strategy, and again, with a long tenure, I guess the speed with which the new management can turn things around is a function of how optimized the prior management team left the accounts to some degree. So here I'm looking for sort of your insights as to the earnings quality, being able, I'm sure, to look at something at the same time and consider it as a potential long or a short.
The main point for me on this in relation to earnings quality for Genus would be three things. So firstly, the company's been through a phase of very high capex. Cash flow has been well below earnings for a period of time for this business. And I think that's not a structural feature of the business. It's a feature of, upgrading infrastructure and bringing, some of their breeding facilities up to very high standards. It's a well-invested business. And I think it doesn't mean that capex is going to continue to be high. It means it will be lower. We're expecting a much better cash flow conversion of the earnings in the next years than we've had in the past. I think the second thing is, and this sits in the earnings, as I said before, there's been a lot of investment in a product that doesn't yet exist. And so, it's inappropriate to value a business based on earnings, deducting those, because either this PRS pig product will work, in which case it will have been a good investment, or it won't, in which case the costs will disappear. And so it makes sense to kind of adjust for those costs. And then the third thing is this point around efficiency and quality, but it does relate to, I suppose, the way the earnings have been reported. And so the company has reported its segments with a lot of costs attributed centrally, not allocated to the business units. And under the new management team, they're allocating those costs. So this is less kind of earnings quality for the shareholder, but more kind of earnings quality in terms of what's the real economics of these businesses. And I'm not sure, without allocating those costs properly, that the business necessarily fully understood how weak the economics of the bovine business was. And so now, under the new management, with those costs being properly allocated, that's very obvious. It's harder to hide from.
So are you looking for them to take action with regards to ABS? Is that one of the key thesis points that you're looking for?
Well, I think they already are. So yeah, I suppose I see two paths on the ABS side. One is the business is brought up to a more respectable level of economics where it's worth owning. And the second is that's a struggle and then it's disposed. That'd be the two paths I'd be hoping for. What I don't want as the shareholder is, the business to continue to underperform, to continue to suck up capital without generating decent returns, and for the Genus to still be owning it in 5-6 years' time.
Should we move on from animal genetics to video games? One of the holdings that I saw was Paradox Interactive, which is a company I know nothing about, but see that it's in the computer games market, which I think is interesting, but I'm not a gamer and I've never invested in a gaming stock.
The history of this company is quite interesting. So it came out of a Swedish board game company called Target Games. Target Games went bankrupt in the 1990s. The surviving entity from that bankruptcy was Paradox Entertainment, which had two business lines really. One was kind of emerging business developing computer games off the IP that were similar to the board games that Target Games had made. And then the other side was licensing of IP. And what we own now is what was then the digital side of, developing computer games that were inspired by the board games. And so these computer games are reminiscent of some of the most complex board games. There's a whole series of these. There's things like, I don't know if you've heard of Magic the Gathering or Dungeons and Dragons. There was actually Civilization, which is, a very successful computer game series was developed from a board game originally. And that was part of a company called Avalon Hill that made a load of these complex board games. There's a whole series of these games where there's extreme complexity. The rules manuals go for, tens of pages often. The games that Paradox is making, we'd call them grand strategy games. They're the kind of modern incarnation of these very complicated board games. So Fred Wester was the leader of that division within Paradox Entertainment back in the late 90s. And he then spun off Paradox Interactive in, I think, 2004. The first successful game they developed was called Europa Universalis. That was in 2000. And that was literally inspired by one of Target Games' successful board games, which was also called Europa Universalis. And so this is a kind of historical simulation, I guess I'd describe it as, where you're in charge of a country and you have to go through, the Middle Ages, and you're navigating kind of dynastic relationships and diplomacy across hundreds of years of history as, say, France or England or whatever. And so, as I say, they're super complicated games. They're hard to design, but they're not that expensive to design. So it's more about skill, intellect, to some extent experience. You're navigating different rules. You need to make sure that there isn't a particular way of playing the game that is the way to win. It needs to be sufficiently complex that if you follow a particular strategy, that will throw up different problems for you, and you'll kind of have to do balancing, I suppose, in terms of the way the rules flow through. And so where we are today is Paradox has 6 of these franchises that are very successful, where they have, over 6 million players across their core franchises. And the players are an unusual demographic. They're older, they're very educated, they're very passionate about these games. These games get much more play on average than your average game would. So it's kind of hundreds, if not thousands of hours that many of the gamers have spent on these games.
Are they predominantly male?
They are predominantly male, not exclusively, but predominantly male. I suppose maybe the games that people would know best that would somewhat equivalent would be things like Warhammer and, like I say, Dungeons and Dragons, Magic the Gathering, these kind of board games that might have a more broad understanding.
Do you find this opportunity as a customer?
Well, actually, this was one of our analysts in the team that brought it to me. So he's a passionate gamer, and he hadn't played these games, but he kind of researched in the industry, which is a great thing to do, to spend time on stuff that you understand really well. His first foray into investing analysis was on games because it's something he knew very well. And he came to me probably 3 years ago saying, within video games, this company is exactly what you would look for as an investment. The investment in developing the game is not all that high. The gamers are kind of semi-addicted to the product. They'll spend hours and hours and hours on them. There's a huge online community and network in terms of teaching people how to play them and contributing ideas on how they should be developed. You need those communities to make them accessible because they're so complicated. And the players will play for so long that you can monetize them. So, you develop the game and then you can sell them lots of additional content to make the game better, make it work better. But at the time, it was too expensive. So probably traded at 10 times sales and, 30, 40 times earnings. And then in the last 12 months, the stocks come right down. They had a couple of failed launches outside of their core franchises, and the market became skeptical and, the valuation dropped a lot. That was when he then came to me and said, look, I think now is the opportunity. Now's the time to buy it. The recent history is also helpful in terms of what created the opportunity. So I mentioned a guy called Fred Wester. So he owns a third of the business, and he was leading it at the time that it spun out and became public. He then stepped away from being CEO in 2018. And during that time, the business tried to broaden. These games are so complicated to develop that they hadn't managed to add very many new ones in quite a few years to this portfolio of grand strategy games. And they were trying to broaden away from that. They invested lots of money in games that were semi-adjacent, but different to their kind of historical core. And largely those were failures. So under a new CEO, lots of money spent, largely failures on kind of broadening the business away from those. Fred Wester stepped back in 2021, and he's returned the strategy to the core. Said, look, this is what we're really good at. We should still work on developing new grand strategy games, new franchises, but let's stop wasting all this cash on the other stuff that we've been doing for the last 3 years. So now the company is much more focused on this core. These games have fantastic economics. They would have gross margins of, call it 80%. And we reckon the operating margins of the core franchises are above 60%. The return on capital is extremely attractive. And if you look back over the history, going back 7, 8, 9 years, the company has grown on this core of the same games. It hasn't launched any new games. For instance, Europa Universalis, which is their original one I mentioned. They're still on Europa Universalis 4, which was first launched 10 years ago. But the number of players on that game is higher than it was 5 years ago and higher than it was 6-7 years ago, because the stickiness and the increasing popularity of gaming in general has allowed them to grow. There's a game they launched more recently called Hearts of Iron, which is a World War II simulation. And that's been growing steadily. They recently launched another downloadable content on that, and that's prompted a big pickup. So they've managed to grow those franchises by 15 to 20% over 7 or 8 years without launching new titles. And that's both adding players. They've tripled the number of players in 7 or 8 years, but also increasing prices. And there's not that much investment that has gone into that growth. So, we think this business can continue to grow now with much greater focus on these core franchises at a decent, double-digit rate. And as we look out, once the investments that they've made in the kind of failed adjacency strategy drop away over the next year or two, it should be on a 7-8% free cash flow yield.
Can you give us an example of how geographically diverse the portfolio is and how you consider country or other macro risks, given what looks like some home bias perhaps in the UK and the dynamic in the US you mentioned with shorting earlier? Your positions in the rest of the world look like they might be sort of rifle shot type single stock selection. But how do you consider that in the overall geographic exposure of the portfolio?
We're mostly invested in developed markets. We've had very occasional investments outside of developed markets, but the vast majority of the portfolio is Europe, the US, and Japan. Japan's a slightly more recent foray for us. In the last couple of years, we did a big scan of Japanese companies in early 2023 in the expectation that capital allocation culture in the country was improving. And we found a couple of really interesting businesses, particularly software businesses in Japan. Software generally is a relatively small market outside of the US. Most of the big software companies are American, but Japan is a bit like a Galapagos kind of separate species. It has a large number of listed software companies that were in markets where the Americans haven't penetrated significantly. And so, we have an investment in a company called Broadleaf, for example, which serves small car repair shops, and it has 30% market share. It's 15 times bigger than number 2. It's going through a late SaaS transition, and we think, it could be on a low single-digit even multiple, low to mid-single-digit multiple a few years out. But broadly, as you say, David, there is some home bias. So our team is mostly European. We hired a Canadian-American investor about a year ago. And I think home bias is both natural and probably sensible. So it's much easier to invest in a place you know very well. And so whilst I make investments in the US as well as in Europe, I do have more positions in Europe and more in the UK. And I probably always will. We adjust for that home bias by having a breadth of team and a divergence of the team. Over time, we'd love to hire a non-English native European and probably a Japanese investor as well. The other thing we need to do is push ourselves to balance the portfolio. So, currently and for a while, we've had a decent long exposure in Europe and particularly the UK and a decent short exposure in the US. And so, when I'm prioritizing my ideas, I'd have a higher priority on finding a long in the US and a short in Europe.
Can you just talk a bit about this issue and what a challenge it is for you running a global smaller companies fund and how you think about these sort of more liquidity driven, passive driven, or sometimes meme driven markets?
The US has massively outperformed other markets, and large companies in the US have massively outperformed small companies in the US as well. Is that market inefficiency or is that just economics? People often say, well, that's natural. Those companies are the best companies in the world. And I absolutely have a lot of sympathy for that. I think going back to the 90s, Brian Arthur was a pioneer in identifying that in a information-driven economy, some of these companies were going to get better as they got bigger. The likes of Amazon, Google, Microsoft, they benefit from scale. And so typically we've been used to, with industrial companies, economies of scale eroding or running out and potentially, eroding as companies get very large. Now these companies, they benefit from more and more data and potentially, even accelerated by AI when, the more data you feed an algorithm, the better it performs. And so we've seen these companies with increasingly good economics taking a larger and larger share of profits and even larger share of the market. That said, there are still many good businesses at the smaller scale. And so as those very, very large companies become 25, 35% of the market, the attention that is spent on the smaller businesses does seem to be ever smaller. And the other thing we have going on is an ever larger proportion of stock market assets being managed by passive funds who aren't doing research on the companies. So I do think there's a strong case to be made that smaller businesses are being, less well picked over than they have been in the past. And then a third element that we have here is we've seen an increasingly kind of manic market, I guess. Retail shareholders have become a much bigger part of the market than they were even 3 or 4 years ago. And so the theory of efficient market pricing is based on people taking independent decisions. And as you can imagine, a Reddit thread that is trying to create a mother of all stock squeezes is literally the opposite of people taking independent judgments on a stock price. They're deliberately trying to create a community-led bubble. And so some of the conditions for an efficient market don't apply. So you've got passive money, you've got the largest businesses being the best businesses in the world and taking the largest share of attention. And then you've got this obvious contravention of the conditions of an efficient market. And when you factor those things in, I think it makes sense that things are maybe priced less efficient. And so I'd encourage people to read this paper that Cliff Asness wrote. It's called The Less Efficient Market Hypothesis. It's an academic paper, but it's written in a super engaging way. And it makes a compelling case, I think, that prices are less efficient than they have been in the past.
The efficient market is basically saying we have a wisdom of crowds. Inefficient markets would say that we have the madness of crowds, but this sort of social media dimension, the Reddit crowd, is sort of flash mob of crowds.
One interesting point that Cliff Asness makes, which I also agree with, is you'd hope then the returns would be better for an investor that is doing the work and is making kind of good decisions of identifying inefficiencies. The problem being it's likely to be a bumpier path.
Yes, I was going to say it's bumpier and could take longer.
Probably right. What we've seen, though, in the UK, for instance, is that there are participants with a lot of money who are thinking from a fundamental perspective. And so we started to see increasing numbers of companies being taken off the market, as you say. So I think if you find a good business generating decent returns that is mispriced, it will either buy back its own stocks, the investors will recognize it, or it will get taken off the market by a private buyer.
Could you just tell us what the biggest mistake has been that you've made in your investing career, and what did you learn from it?
It's a very hard question, Jeremy. There's so many to choose from. But I tend to think that in general, the biggest mistakes are not the ones that you've made and lost money on. It's when you have not taken proper advantage of something, when you had a real insight. I think that's probably the biggest mistakes. And so to me, that's probably identifying the opportunity that was in online classifieds and, this broader returns to scale point that we've already talked about. Back in 2010, that was when I identified it, and not following that determinedly enough and kind of exploiting that as much as I could have done. There's private equity firms that basically only invest in that world. And, perhaps I should have followed that, as that would have been a much more productive investment career for me if I'd invested in some of these PE deals that have taken out some of those classified businesses. But it goes broader than that. So, for instance, there's a massive similarity between the pricing opportunity that some of those online classifieds businesses have and a business like FICO in the US, which is, makes the FICO score that goes into credit decisions. And I came across that business. I suppose I didn't allocate enough time to fully understand just how much pricing power it had. And so I saw it as an opportunity, but I didn't invest. And the stock's probably up 6 or 7 times since. And, really, that's exactly the kind of business that, with the framework and the knowledge that I have of some of these models and the power of that kind of pricing opportunity, I should have invested in. I think it's probably those missed opportunities that are the biggest mistakes. What's the lesson? I always ask myself this: how can you spend your time better, I guess? How do you avoid spending time on businesses that are mediocre? And how do you make sure you spend time on businesses that are special and that really have this potential? That's an ongoing question. So if you have any tips on that, I'd love to hear them. But
it's knowing when to pull the trigger, isn't it? And I share your frustration over the long haul of the great investment ideas that I've allowed to get away. And I don't know, I imagine you're the same, David.
It's the lure of the shiny new thing, isn't it? It's sort of, you need that sort of curiosity to keep turning over rocks, and it's a key sort of source of returns and ideas over time. But somehow you also need to suppress that, as you say, and then recognize when you have a core insight that is going to be higher returning to focus on.
Yeah, I would say, to take your analogy and just extend it slightly, it's turning over rocks, but kind of throwing them back into the sea quickly. You want to look at a lot of things, but if you can dismiss things very quickly, then you stand more chance of...
It's a process of falsification, isn't it? we progress one failure or one rejection at a time.
This is something I'm always saying to the analysts that we have here is, a successful year is saying no to lots of things. If you can say no to lots of things, there's a good chance that even if you don't think you have, that you'll find something that's very good. What you don't want to do is spend weeks and weeks on an idea that isn't going anywhere.
Well, as an institutional broker that talked to many investing clients over the last couple of decades, I can attest that Ennismore's got a very good history, as far as I'm concerned, of saying no to virtually everything I put up to them. So you don't want to beat yourself up too much on that front.
I can only apologise.
No apology required. Rich, thank you so much for your time. I've thoroughly enjoyed it and learnt a lot and some great ideas to consider. I think you've made a strong case for long-short global small cap equities, and wish you all the best for managing the fund going forward, and hopefully we can catch up sometime in the future.
Thank you very much for having me on and for the opportunity to talk to you guys. I enjoyed it.
Brought to you by Progressive Equity.